Hello everyone, Dividend Enjoyer here, and today I'm going to be doing a stock analysis video on Smuckers, ticker symbol SJM. Smuckers stock is down 21.58% over the past year as of recording this video. The market cap is 10.95 billion, the price to earnings ratio is 20.63, and the annual dividend yield is 4.21%. Based on 10 Wall Street analysts who have issued ratings for JM Smucker in the last 12 months, the stock has a consensus rating of hold. Out of the 10 analysts, one has given a sell rating, 6 have given a hold rating, and 3 have given a buy rating for Smuckers. So the consensus is it's pretty close to the fair value, or it's not going to have a lot of upside. But it's not quite so bad that if you already have the stock that you should sell out of it. That's kind of the analyst opinion of it. And according to the 10 analysts, their 12-month price targets for JM Smucker, the average price target is 127.33. The highest price target for SJM is 136, while the lowest price target for SJM is 121. The average price target represents a forecasted upside of 24.09% from the current price of 102.61. So that's weird that so many of them have hold ratings, but they're expecting the stock to go up 24% in 1 year. So I don't know, kind of interesting. Probably not a good sign for Smuckers. Interest rates probably not helping them. A lot of things kind of working against them, but maybe they can turn it around and maybe it's oversold at this point. So that's what we're going to find out with the DCF valuation. Smuckers currently also has a 1 year dividend growth rate of 2.88%, a 3 year dividend compound annual growth rate of 4.23%, meaning that on average over the last 3 years, the dividend's grown 4.23%. The 5 year compound annual growth rate of 4.35%, and a 10-year dividend compound annual growth rate of 5.78%. I'm guessing that the 5 year being the only one that's better than the sector is because COVID somehow hurt this company. It's pretty common to see that some companies got hurt more than others, and it would just make sense to me that Smucker's probably got some of their growth limited by COVID just because of either supply chain issues or rising costs of fuel, energy. There's a lot of things that are kind of working against Smuckers right now. Debt, interest rates. I think though, like overall, this will just be a small blip. I do think that this is a quality company, but I don't think that their product is very monopolistic, which I don't like. But the dividend growth rate is acceptable, I think. You can see here, Smucker's valuation is currently pretty close to in line with the average growth rate of the free cash flow being negative 5.24%. I think there could be definitely be some upside here. You could argue that the stock is just going to grow flat with the cash flows. But I think, and then you'd have significant upside. It'd be worth almost double. But I think the stock is just getting hurt because I'm going to be completely honest. This is obviously not financial advice. I'm not a financial advisor. But I think unless this was like incredibly cheap and I understood exactly how they were going to grow the cash flow bigger and grow everything bigger, um, I don't think I would want to own this company. I think it's in like the late stages of how mature it is. And I think that it's kind of just going to be stagnant because it's in a very competitive industry and they're constantly having their market share taken away. And I also think that this is one of those things where, yes, it's a premium brand. They have the top jams, but if I'm at the grocery store and I'm not making as much money or I'm just wanting to save money, I'm going to buy, the Walmart brand of jam or something like that. And I think that's reflected in the cash flows. And I even use the trailing 12-month number, which is the nicer number because this is the April number for each year. Um, so this number might be higher just because certain seasons, people spend more on jam, which I'm guessing is the case. Um, Even though this looks like a buy, I think this is a value trap. I would not want to own this type of company personally. Um, but I think it's good to like value these every once in a while. But I find it super interesting that it's so close to in line whoops, negative 5.24. It's so close to in line with the cash flow growth that, it might be close to fair value here. I think that people get into the habit of saying, "Oh, I know this company, like the marketing's good, I like the product, so I'm just going to buy this," uh, without actually thinking about the business model. And I think Smucker's is one of the perfect examples of that, where people think just because Smucker's is good and they like the Smucker's jam that it's a good buy. But if you really critically think about it, they're not as quality of a company as something like a Microsoft or Amazon, or I mean even Apple. Even though I don't like the growth prospects, I really don't like the growth prospects of Smucker. And it's not like real estate or something like that where it's something that nobody can really compete with you if you own like a piece of land in that area with a specific structure or something built onto it. This is just jam. So, I mean, different things can drive down cash flows that are out of your control. You're in a heavily, heavily competitive market. You're always competing for shelf space. You're always trying to figure out how to grow your cash flows more. And I don't like a business that is, for one, very mature like Smucker's, and for two, very competitive like Smucker's. Um, and I really don't like too, because if you look here at the weighted average cost of capital, they have a pretty high market cap, but they're 43.98% debt weighted compared to the market cap. So they have a huge amount of debt, and their interest rate is, pretty high. It's 4.635%. Um, because they're obviously getting the tax write off on that, or a tax shield on it. But it's still, I mean, it's not a good environment right now for Smuckers, and I think they're going to continue to suffer. I think if you understand the industry and you honestly think that they have the chance to just keep the cash flow where it's at or grow it slightly, I think that this obviously is a buy. Um, but I just wouldn't want to hold this stock because I think it's going to keep underperforming and just, yeah, there's a lot better things you can put your money into you'll be happier in 2 to 3 years that you bought than Smucker. That's kind of my review of it. Um, it's unfortunate. I like looking at some of these because I think that they can be really good value plays, but I just don't think that Smucker is going to be able to consistently improve everything. I think it's kind of like a lottery where it's going to be very difficult. Um, it's going to be based on your own personal convictions about what's going to happen in the broader economy and if they can grow or if they have some kind of. I mean, they do have the advantage of being one of the bigger ones, um, but it's not like a industry that's super hard to enter either. So that's kind of my review. I don't like this company just from the fundamentals. I think the valuations may be low, maybe on the lower side, so maybe you could pick this up, but I don't think the quality's there for me, and for that reason, I don't think it's a good investment personally. That's the review. Thank you guys.